no idea why it's doing that. There we go.
Yay. Perfect. Perfect. Hey, let's start with this. I wanted to introduce everybody here. A few of you were on a meeting we did. I don't know. God, Peter, what's it been? Back in March?
Anything? Probably on the front end of the virus sort of starting to really pick up steam.
Yeah, you know, what I remember about when the other meeting was is it was about when the Dow hit 18,000, more or less. What did it bottom out at? 18 and some change, right?
About 18.5 approximately.
Yeah. So I think the Dow was maybe 19 ish. And part of our conversation at the time was, you know, put money in, don't be taking money out, for God's sake. And I believe the Dow, what did it close yesterday? Is it, right now it's at, I see it on TV, 26,683. So our last conversation was the Dow was about 19, and now it's at 26,680, down a little bit from the last week high, more or less, right? But give you a little bit of background for Peter, and I'll give you a little bit, give him a little bit of background. Feel free to expand on it because I'll make it the short version. But Peter and I have been working together for at least 15 years. Someday we'll figure out how far back it really goes. But we've been working together for at least 15 years. Working together in part because he's my trusted financial advisor and handles all things that investment related. And in part because we've worked together on a variety of other business ideas and bouncing things back and forth over the years. But one of the things I wanted him to take some time and introduce everybody is, you know, Master Smith and I were talking just, I don't know, a few days ago, and really this came about in February pre-COVID. But, you know, we call the organization Martial Arts Wealth Mastery, but really what our strength here, to be completely honest about it, is I am really good at creating as much intro traffic and as many new students as anybody could possibly handle, better than anybody who currently exists or has ever lived in the industry, to be modest about it. But also really good at teaching you how to get the gross up, keep the expenses contained, and create some strong net cash flow. Master Smith is really good at all those things, but really if you wanted to put it in, he is great at student retention, at the renewal processes, at creating people who want to be black belts and then turning them into champions, right? So if there was ever a teacher's teacher in the industry who was as good as you could ever be at that, Master Smith, that category. And Master Moody is our official egghead, PhD in education, who has all the systems down, and whether it is discipline in classroom, processes for renewal, processes for retention, processes for traffic flow and so forth. But nowhere in that description is pulling a bunch of money out of your school and putting it somewhere where 10 years later there's a big stack of it you can go look at and feel some comfort there, right? So martial arts wealth mastery to date really was martial arts income mastery, revenue and net cash flow mastery. But our addition of Peter Harnish here is to encourage you to not only get your income up and buy a Rolex and sports car and whatever it is that you always wanted as far as baubles, but to take the majority of that off the table. And he's an expert at tax implications, at growing money in the most expeditious way possible, where to put it, whether it's retirement plans and college funds, but also insurance, you know, life insurance, personal insurance needs, etc. Pick up from that a little bit, Peter, on really what your niche would be within our organization here for a second.
Sure, Steve. I think, you know, first and foremost, to the interactions that I've had with a number of folks that are in process of becoming clients, you know, again, our process is going to be, you know, similar to what other professionals are going to look at. What we want to try and do is assess the situation of each individual martial arts academy, martial arts studio, understand what their long-term goals and objectives are, understand their ownership structure, understand how they would perceive and how they would like to consider potentially exiting the business at some future date. And as we gather that data, we then begin to make a plan and create a plan and a set of recommendations to achieve that objective. The findings to date lead me to believe that these academies that are being extremely well run certainly are going to be high cash flow endeavors, and can certainly spin off a lot of current income. The general feeling that or the general observation that I would have to date, based on the individuals that I'm working with, is that most of them will transition either to family members, other instructors, or maybe just run it until they no longer are able to run it and then close that studio down. So there are some pathways to exit, but I have yet to hear of one owner assess that the exit would be through a outside liquidity event purchased by some other individual, and that would then serve as their windfall. And again, if those statements are accurate for the broader group, then to your point, what's critical is that we look at this asset and we say, how do we on an ongoing basis systematically divest ourselves from the business while still being good stewards of the business, growing the business, keeping money in the business, but nevertheless divesting ourselves systematically from the business. And I think that's the opportunity that a good plan and good fact gathering can bring to light to an owner. And then from there, once we begin to build the framework of that systematic divestiture, then you begin to implement the other solutions that are vital to the business, whether that's funding a buy-sell agreement and using the tax-deferred strategy of the buy-sell to accumulate capital for the owners, and or a whole host of other strategies that might avail themselves to us over time. But the development of the plan, the strategy, and then the idea that we're trying to systematically divest ourselves from this business, I think are critical. And some of that might also go to real estate. Some might go to other outside strategies that do not have necessarily everything to do with me. I mean, I've had the pleasure of talking to a number of folks around other transactions that frankly don't have a lot to do with me. We're not gonna assist in the commercial real estate purchase or sale or development of, but we can provide guidance, and I think we can become a trusted advisor to the folks on the video conference, and be able to give them other things to consider as they go about developing that wealth accumulation strategy.
Yeah, and Peter, maybe said differently, what's really unique about martial arts schools is, maybe phrase it a little differently. Almost every business that I've worked with, and Peter, that you've worked with, it's kind of like the old line about a boat. The happiest day in a boat owner's life is the day he buys and the day he sells it, right?
Correct.
And almost all small businesses kind of start and build the business with the idea of they're going to sell it and make money and not have to do whatever business they're in. Dentists are a good example of, I've worked with a lot of dentists, and it doesn't seem like dentists want to be dentists, after they've been a dentist very long. What they're looking for is, how do I build wealth to get out of it? What's unusual about martial arts schools is two things. One is, Peter, as you said, and I'll paraphrase it, there's very rarely someone who's going to go give you $5 million to buy you out at the end of this deal. In a lot of other businesses, you build a big dental practice, there's other dentists that'll buy you out. You build a big financial practice, there's other financial advisors that'll buy you out. The way that a martial arts school transfers usually is the owner gets tired of it, or gets old enough that his kids take over, or her kids take over, or some student takes over and they promise to pay you for a while and usually don't pay you for very long, and it's you're just kind of out of it. What that means is, the way you build wealth when you're running a martial arts school isn't that the wealth is the business. It can be that the wealth is the building that you're occupying, that you own. And so then when you're at that point where you want to retire one thing or another, you own it outright. The other thing is, you pull cash flow out of the business, do it in the most tax appropriate way, but you build it through investments, you build it through a diversified portfolio, you build it through life insurance investments, et cetera. But you pull the money out of the business and put it somewhere where it's protected, and you should be taking a percentage off the top that not is rainy day fund, but is just untouchable, right? So really what we should have is we're pulling money off for if we took a hit in March or April or May on COVID, for instance, as that rainy day fund. But really what we should be doing is pulling money off that's untouchable. The worst thing in the world you could do is, you spend 20 years and you bring in 20 or 30 million in revenue through your business. And at the end of 30 years, you look back and you brought in 30 million, you spent 30 million, and you don't have any assets to show for it, right? And so really what our mission is to take each new member and truly turn them into a millionaire, not a millionaire from revenue and cash flow, but a millionaire from revenue, cash flow, and they have hard assets in the bank and have that stability. And the reason that we're talking to Peter today, and what we really want to start doing is having each and everybody talk with Peter, and maybe there's some other people that you work with, and that's fine too, but really to have a plan for how do we get our revenue up, how do we make that turn into high cash flow, and how do we pull a portion of that off into untouchables so that 10 years from now you really have long-term wealth. The other thing, Peter, I think is unusual about this is it's not a business, like I mentioned before, where people buy it with the intent of selling it and they hate every minute of it, right? Really, most people who get into martial arts are getting away from something they don't like into something they think they'll love. And if they do it right, they continue to love it. If they do it poorly, they don't, right? There is that aspect to it. But people that we're working with tend to really love their career and love their job and really like doing what they're doing. That leads to a fallacy of thinking they're going to be able to do it forever. I mean, if you look at my instructor, Jun Rhee, he was really good at running his business until he really wasn't able to run his business. And if you do that and drive great revenue without creating assets, it creates a problem. So this really is a business that I think very few of us are looking at, oh my God, when can I sell this and be the hell done with this thing? It's something that we really want to do. It's just that the business itself isn't going to create that long-term wealth.
Yeah,
Peter,
to your point, Steve. I think the business, to your point, can create significant cash flow. Yeah. And then that cash flow, if we divest it properly, can then grow and then create that future wealth, if you will. So yeah, I completely agree with that. And that's why the plan is so critical. We always can have reasons why the timing is not right to institute a plan. I mean, is the timing ever perfect? Probably not. I think the most critical aspect is develop the plan, understand your plan, and then to begin to incrementally implement it. You may not implement the entirety of the plan immediately, but you set a goal as to what that target should be, and then you incrementally grow to that.
Yeah. And Peter, one of the things I see, and of course you deal with a much wider range of business owners than I do, but almost all business owners think, well, now isn't the time for me to do it because I have these things I need to spend money on the business. I have these things I need to do. But when I get to where I have excess cash flow, I'll do it. And when you're thinking that is exactly the time that you should sit down with Peter and you should put together the plan. It's the opposite of what most of us think. And especially when times are uncertain, that's the time when you really need to sit down and you need to look at what's my outcome in 5 years, what's my outcome in 10 years, what's my outcome in 20 years. And I view it just like, we all take credit cards. Nobody in here counts the merchant discount fee that's coming off the top because you just get the net deposit and you're not thinking about it, right? I think of it like that. Every dollar of revenue that comes in, a little bit needs to go to the rainy day fund, a little bit needs to go to untouchable, and it comes off the top. And then when you build perhaps a small percentage off the top to begin with, let's say I'm taking 5% off the top. Well, if I'm barely breaking even and I start taking 5% off the top, guess what? The revenue grows. to accommodate it. And so then I can take 10% off the top, and then I can grow the revenue a little bit more. Then I can take 15% off the top. So it's having a percentage that just comes off the top that you never see, that you never think, I'm going to go buy that new Corvette that just came out. You never think that I'm going to reinvest in the business. It'd be a nice time to put new mats in. It just comes off the top and you don't see it, and it grows and builds. Peter, the other thing I see a lot of people do is when they start pulling some money off, especially when they put it in the market, is they start paying attention to it every day. What should be the cycle of paying attention, and who should be paying attention to it?
Well, you're paying me to pay attention to it, and I would say that if you develop an appropriate plan, again, if you develop an appropriate plan, you really assess your own personal tolerance for risk, your aversion therefore or thereof, or your lack of aversion to risk. At that point, we put together an allocation strategy, and frankly, that allocation strategy at a maximum you should look at maybe 4 times a year. I would probably tell most clients look at it twice a year. You're hiring me to develop that strategy, to implement that strategy. We'll do our due diligence up front together. And as long as we're doing that due diligence, once we agree to and implement a plan, now it's my responsibility to take care of that plan. Go back and build your martial arts business, and I'll worry about the portfolio. That's really good advice. The rule number 1, I think you would agree, Peter, is to take money off the top that you're not going to see again, that you just get used to, and you start with a small percentage if you need, and you set a target of 3%, then 5%, then 7%, then 10%, then 15% just comes off the top, and you'll adjust for it from there. On the risk thing, I know you explain this well when you meet with people individually, and you're explaining it well now, but the risk thing is really about time horizon, right? If I'm taking money off the top that I need in 4 years for my daughter's, college education, it's a different calculation than if I'm going to look at it again in 10 years and I want to be wealthy in 10 years, but not touch it in the interim, right? So it's a great extent about time horizon. As we compress what we would call duration in our parlance, as we compress duration, or that time factor, the markets can become much more uncertain. If you look at any incremental, week, 1 month, 6 month, 1 year, market trends, those are difficult to predict on a daily basis, a weekly or monthly basis for that matter. When you start to expand time horizons or durations beyond 5 years to 10 years, the market becomes extremely predictable. So the idea that the market is risky and or a crapshoot at a 10 to 20 year time horizon really is false. It's extremely predictable. Now, we don't know if it's going to grow by 8% or 7% or 9%, but we know the markets tend to gravitate up. We don't really have any rolling 10-year periods historically where the market has not gone up on some incremental basis. So the idea of risk in the market is a function of time or duration.
Yeah, and the markets tend to be residential real estate, commercial real estate, all of the other things that you can put money in. Is that an accurate statement, Peter?
Yes.
Yeah. Wanted to fact check me here for a second, but the commercial real estate thing, the advantage that we do have is oftentimes you can purchase the building that you're in. So you then become your own landlord. And frankly, the most successful transition strategies I ever see with schools is the ability to sublet or to lease the facility to the new owner, and then have them do a long-term payout or a cash deal. Because then you have an awful lot of leverage. And frankly, oftentimes maybe the school isn't in that building long-term, but you have asset that can create revenue flow as well. So we never discourage anybody from buying the building as long as they buy wholesale and get the amount of square footage that they need, or get something that's maybe slightly bigger that they need that they can also lease. That's one strategy that we use. The other strategy that I want to get really good at with everybody from day one is really starting with a plan to take money off the top, put it into the untouchable fund, money off the top also to put it into the rainy day fund if you want for that. Because, seeing anybody have cash flow problems the last few months really you should have had some assets there to fall back on and should have implemented the right strategy quickly. But we really want to get good at take money off the top that you don't see, get used to it just going away, and then having a long time horizon where you're really wealthy at the end of that, rather than you've had a good run with good income and some toys along the way. And by the way, Peter, we share a common interest in toys. So none of the above is saying not to have the 911 Turbo, which we share in common. Although,
Correct.
Peter, you've got one much newer than mine, so I'm jealous of yours. What's your next toy going to be? Oh, I know it's the GT3.
Yeah, I don't know. I mean, I've got a fairly demanding wife at home, so maybe it's going to be something that she wants me to do for her first. But no, I mean, Stephen, you talk about that, and I think part of that, grander vision, I think that I have for my clients, and I've expressed to the folks that are working with me out of your group now, is it's not just about savings. To your point, it's about saving. It's about having financial security, and it is. Excuse me, there. I'm not sure what happened there. But it's also about enjoying yourself. I think that the structure of the plan and really developing a plan that works will allow us to do a whole number of things that make the efforts that we put into our various businesses more enjoyable. And I think one of those has to also be, if it's the new house that you want or the remodel or whatever it might be, we want to incorporate that into the strategy as well. And it requires discipline and structure. And with the folks that I've been working with to date, which I really enjoyed working with, they all have one thing in common. They have a very, they have a time horizon. They have a vision. They believe in structure, and they're very goal driven to achieve, these objectives that are not only just related to their martial arts practice, but also to the other elements of their lives.
Yeah. And Master Oliver, I like it, how we teach everybody how to work for their money, and then Peter's going to teach them how to make their money work for them.
Oh, absolutely. Absolutely. Well, and that's so important. To me, psychologically, the first most important thing is, no matter whether you're having good month, good quarter, bad quarter, is a percentage comes off the top. And then you put a deadline for yourself for that percentage to keep increasing, right? Or you just make it starts at 10% and next year it's going to be 20%, but you just take that percentage off the top. You never see it. It's just like, paying the Visa processor, their 3% or whatever it is to process it. And you just never see it. So you don't make a decision on whether you're going to spend it, whether you're going to pay bills with it, whether you're going to buy toys with it. And then you can look back 10 years from now and truly be wealthy, as opposed to a built a good business that's going to spin off cash flow. But the thing to remember is, other than the real estate aspect, it's rare for our business to actually become a business that is going to, somebody's going to pay you cash for. Happens every now and then. I've seen it happen from time to time. Or what I've seen from time to time is a student buys the business and they are going to pay you $3,000 a month for 3 years, and they actually pay you the $3,000 a month. Most of the deals where they are going to buy you out over time only last for 9, 12, 18 months, and they stop paying you. And most of the time it's because they ran it into the ground and don't have the cash flow, and you're the first person they stop paying. So you really have to not think of the business itself as the long-term wealth strategy. It's the real estate it's in, and it's the money you took off the top and invested elsewhere that you're not going to look at.
Well, and Master Oliver, if I could just add that I think we've seen that happen so much, that don't get distracted that you think your situation is going to be different. And maybe some of the people on the call might be thinking, well, yeah, but this would be great. Again, I'd just like to reiterate, for the day that things turn around and I have excess cash. Now, these are things you got to start planning for now. This is a good time to be thinking about what your long-term strategy is and where you're going to end up. So this is the time to do that for everybody on the call, not later. And the younger you are, the better.
Yes, sir.
Oh, absolutely.
And Stephen, just to add, a couple of things, right? The market's counterintuitive. So theoretically, the best time to have put a large chunk of money into the market, if you would have been able to, would have been the end of March. Would have been the absolute ideal time. So markets are counterintuitive. You need to, when everybody's running for the door, you need to be running in. That's sort of a sidebar note. What's also extremely important to understand is that what we try to do with all of our clients is quantify that retirement income need, and that retirement income need is going to be then based off of some corpus amount at, let's just say generically age 66. And what we find, and this is what I think is really, really critical for everyone to understand, and why what Stephen is saying is so really vitally important, is that even if someone would be an outlier and, let's just say, sell their business for $500,000 or $1 million, that money would more than likely not represent the capital needed to generate your retirement income for the next 20, 25 years, assuming life expectancy to 85, 90. So even a transaction out of the business that appears to be somewhat unlikely or an anomaly for this space would not then necessarily be enough to then enjoy and maintain a retirement lifestyle that would then be commensurate with your pre-sale working lifestyle. So it's critical to save money as you go, because even if you were to have a liquidity event at age 65, 70, through an internal sale or what have you, more than likely the money that you would generate out of that sale would not be enough to maintain your retirement objectives.
Yeah.
We have a lot of young members that that have a younger family that they have to start putting aside those college funds. That college tuition is not going to go down over the years; it's going to go up and up. So, it's good to have that ready. Because what you invest in it now, the return on your investment is like by the time they're ready for college, it's like 1 year of what you invested, that would have paid for 1 year of college, by then would pay for all the college. It's so you have a good opportunity to take care of that problem later on.
Yeah,
well, and you're raising a good point, and that's also goes to sort of the other idea concept wise, which is what do you want your business to do for you? And what I mean by that is, in what manner can the business help you to achieve those objectives? And towards college planning, there's a lot of things that you can take advantage of that allow you to literally put money away without any transaction costs. And that's code for fees and commissions, by just working it and running it through the business. And at some later point, we can talk a little about that, Stephen. But yeah, you can utilize your business in a number of different ways. And for college savings, there's some really neat ways you can put money aside. It's a no-load, commissionless strategy. You can use a 529 plan, and because the business is sponsoring it, you can save a whole bunch of money by doing it that way. So the business can help you in some manner to leverage those dollars as well. Yeah.
I think if I remember correctly, Peter, when we first started working together, that was our objective. Is we had orchestrated my nightmares. I think I had 70 employees at the time. And what we were looking at is key man policies. We were looking at key man compensation, deferred compensation, insurance plans. And that's the other thing, that everybody should be in good shape with life insurance and so forth. If you're 34 years old and you have 2 small kids and something happens to you, you can't count on the school is going to continue to generate revenue to support them. You've got to have those things taken care of as well.
Yep. And retaining and key employees. If you've got good key instructors, there's certainly things we can discuss there. And there's a whole host of things to address in that respect as well.
Yeah, absolutely. Hey, Peter, anything to add before we to shift back to some of our other topics here?
No, it was a pleasure speaking with you all today. And again, I'm certainly happy to have any and all conversations. I've enjoyed, for all of you that I've had a chance to talk to, I've really enjoyed my time speaking with you and working with you. You're a great group of people, and it's been my pleasure. So,
again, I don't think I ever gave. Go ahead.
Maybe we can put his contact information for people to contact him just to get an understanding of all the opportunities. When he started talking about the benefits of investing, company in the college fund and things like, there's so many loopholes and things that you can utilize that somebody who's in the business of investments knows all these things that, you know, that actually finds you money that you never knew you had.
Yeah. Yeah.
So
Well,
we put that in our Facebook page is what I was trying to say.
well, yeah. Well, what we'll certainly do is coordinate, just like we would do a progress update with anybody. Peter's volunteered. There's no charge, no obligation, no sales pitch. He's happy to look at your current situation, look at the long-term situation, give you his best advice. Peter, I never really gave them much of your background, but you've been doing this like forever. Not to
Feels like it.
Yeah, not to date both of us, but you're a wealth manager. You're part of the private client group at Northwestern Mutual, which is the top. You know, you're the top 1% of Northwestern Mutual is. I think this is a fair thing to say, the most stable organization in this field. It's. I was just looking at the list of the top companies, and it was in the top 20 of the top companies in the world. Talk a little bit about your company and your status within the company before we go.
Sure. There's about 9,000 of us, Stephen, to your point. And Northwestern most recently came out with a sort of a special subset of advisors that they want to allow to have greater latitude and greater access to certain things. There's about 150 of us in the country. So I'm not sure if it's probably the top kind of 0.001% of something. But we're part of what's called now Private Client Group, which means we're going to have extra capacity from a planning perspective, things of that nature. So that's going to be exciting. And it's certainly something that can benefit all of the, martial arts businesses that we work with from the standpoint of planning and access to different and hopefully better ideas. Northwestern Mutual, along with Microsoft, was just affirmed by, I think it was AM and Best, as two of the most, or the two strongest financial organizations, the two strongest corporate entities in North America. So that's kind of a pretty neat thing. And that's certainly saying something, because I think we'd all agree that Microsoft is certainly a company that would not be surprising to be on that list. And I'm not surprised Northwestern is either, but it's probably not as well known from that perspective. So, I think what Northwestern's been able to do is instill inside its culture one of planning and one of hopefully adding long-term value to all of its clients. And I'd like to think that we adhere to those principles. And it's, I think, really critical to know that you've got a partner when you're someone like myself in a Northwestern that will deliver on its promises for our clients.
Yeah. Well, and frankly, I mean, just to speak completely frankly, an advisor in your position, a wealth manager in your position, most typically is dealing with people with cash flow and assets quite a bit higher than most of our members, our newest members. The reason why you're going to put that much extra time and effort really is because of our relationship and because of the education that we're doing with our niche with you and the support that we're giving them, that we have great confidence they're going to grow into one of your private client qualification levels there.
Absolutely. Yep.
Yeah.
Absolutely.
Yeah. Good. Anybody have any quick questions of Peter, or any quick thoughts before we shift gears and let him get back to having a real lunch for a change?
I just wanted to say that we love working with Peter. Enough said. That's all I have to say.
You can say additional nice things to him or about him, Olga.
Well, Peter's just been, he spent so much time with us, and we really feel excited about the plan that we have in place with him. I mean, it just took, contacting Bob. I think he set up our appointment, and then, I mean, we talk about customer service in our industry, but Peter spent insane amount of hours with us, just, really finding out what we need and basing his plan on our needs. So I'm very grateful that you connected us with Peter. I know that he works with very successful people, and so we're humbled to be his clients.
And Master Oliver, I'm happy to be that bridge again if that helps Peter out. So you guys let me know.
Yeah, that's probably a much better approach. Is if anybody wants to schedule a time, give Bob a call and he'll coordinate with with Peter's back office staff to get it on the calendar. Just like me, we don't want me or Peter controlling our own calendars because that doesn't work out so well.
Alexia, go ahead, Alexia.
What I was going to say is that for anybody whose knee-jerk reaction is to be like, oh my God, I don't need life insurance or whatever. I was also in the financial industry for 10 years prior, and it is one of the most valuable, underrated, like misunderstood tools that a business owner could have. So like coming from being basically one of you, and also at one point being one of him, you have to understand the long-term value. It far surpasses any misconceptions that you would have of it already. It's one of those things that you're just like, I didn't know it did that. And everybody wants what it can provide. It's just that knee-jerk reaction of, oh, life insurance, or something of that nature, like, or annuity, I've heard bad things. You gotta get over it and like just pull the trigger, because the earlier you do it, the better. And now is the best time, because you'll see those long-term dividends and the appreciation of all the value inside of it. As soon as you can do it, you should do it. I tell everybody, I tell like my 18-year-old students, I'm like, go do it now. Now is the best time to do it. Go. I'm like, all the parents, no matter what, it's such a valuable tool for pretty much anything you need to do with it long-term.
Yeah, that's right. The best time to have done it was 10 years ago, and the second best is right now.
That's right. Like,
short of having a time machine, right?
Yeah.
The thing not to do is wait. Wait till everything is perfect, because it's never perfect.
Correct.
And you never wait to start taking the 10 or 20% off the top until you can afford it, because the thing is, you'll never be able to afford it. Your expenses and your lifestyle will grow to accommodate whatever revenue. So you've got to get money off that you never see coming through the cash flow, and then frankly, your revenue and your profitability will adjust itself in that direction. Peter, one of the things we haven't talked about, but I think one of the key components is now the word is going to escape me. Is dollar cost averaging. You want to have money coming off the top every week or every month, and going somewhere every week or every month. And that way, if the market's low, you're buying more. If the market's high, you're buying, and it's just constantly coming off. What you don't want to do is try to accumulate a bunch of money into savings and then time things, really, other than that's what Peter and his team are really good at managing that for you. But Peter, you said something a minute ago, which is vital for everybody to hear, is if there's one principle you want to be a contrarian, it's when everybody is running away, you want to run towards the fire. The best day to have bought would have been the day after 9/11, the day after the market crashed back in 2008. Or when the market bottomed in March. The second best way to do it is just money's always going in, and you're not thinking about it, you're not looking at it, and you have somebody managing it for you so it's allocated properly. Is that a fair description, Peter?
Yeah, I mean, absolutely. I think the outside resource that I would tell everybody if they want to, hit the Google machine is just pull up, just type in Franklin Templeton. He was the founder of the Templeton Funds. And you'll find a whole slew of information on him out there in the internet, in the World Wide Web, so to speak. But he was very much a value investor, and he was about buying good companies. So he was sort of a Buffett before Buffett. And he just talks to these types of fundamental principles. And that's, I'm really a disciple of his, I guess I would say. And I think the idea of buying when there's value and there's opportunity, being systematic, are critical. And the reality is, to your point, it's extremely difficult to be so disciplined to set aside large amounts of capital and at the absolute right time in the right month of the right day to buy in. And what systematic investing allows you to do is make it very unemotional, right? We're pulling that emotion away from this decision, and we're just making it very systematic, and we're building it into your day-to-day activities.
Yeah, absolutely. Well, I guess we could end on the story you told me about the Templeton Fund was what the average return to the fund was what, and the average investor actually received what? I forget the.
Well, there's a story about Fidelity, and hopefully I don't.
Oh, Fidelity. I'm sorry.
Yeah, Fidelity. It seems to be a common occurrence here, Stephen, that my phone tends to go low on juice here. But Fidelity Magellan, which was the #1 performing large cap growth fund of all time, and had a rate of return, I think, historically over the first 20 years, when it was managed by Peter Lynch, who was a legendary money manager, of probably north of 10%. That was the fund's historical return. Yet the average investor that invested in Fidelity Magellan, their average return was about 4.5%. Well, how could that be? Because there were many investors that were there at the inception of the fund, and that just goes to market timing and people being in and out of the fund, buying in at the wrong time, pulling out at the wrong time, and not being not applying that buy and hold strategy. There's reams of data out there that will show you if you miss the best 5 days or the best 10 days in the market over any 10-year period, your return can be affected by upwards of 1.5–2%. Think about that. So can we really believe that we'll know the 10 best days? It's not really possible. And how would we avoid being out on the 10 worst days? Probably not possible. So, right, the lesson learned is to be systematic, to buy in, to build a philosophy, and to stay invested.
Yeah, excellent. On that note, if anybody has any last questions, or anybody wants to echo Olga's comments about how wonderful Peter is as an advisor or human being, feel free. And otherwise, we'll call it a day before his cell phone battery died. And Peter, I'll send you a tripod, and there's this little white cord that I'll send you one of those too. That works with the tripod.
Don't work with me because of my technological acumen. That would be bad. But,
you better stick in the charger that plugs in the wall to go with that cord.
Yeah, I've got one of those that you can put the phone down on, but that's not going to work. Olga, by the way, you're very sweet for saying all the things you did. And as a quick reminder, you and I should have a follow-up conversation on some of your exciting stuff you got going on here in the next week or so when you have a chance. So I'm going to have Julie reach out to you.
And Peter, I'll give you a holler later this afternoon after
Wonderful.
Your phone has been recharged.
Yeah.
Okay. Thank you, sir.
Right.
On that note, again, what we really do want to make sure we're doing here is that this really is wealth mastery. So is to help to teach everybody how to create enough revenue flow that you can be taking 20 or 25% off the top that you don't look at, that is building wealth for you. And the best way to do it is to have somebody like Peter who's managing it for you and directing it, so you're not spending a lot of time thinking about it. The worst thing to do is decide that you're going to become a day trader for 3 hours a day during the day and try to play the market, because that just doesn't work out very well for 99.9%. Probably the thing to think about, to echo what was being said earlier, is there's a zero-sum game. And a zero-sum game is, I go to Vegas and I put money on the craps table. I'm either going to win or lose, regardless. The casinos are going to take their rake of 3% by the time it's all done. And a lot of people think of investments in real estate, investments in the stock market, and they think of investments tied into life insurance and so forth as being a zero-sum game. The reality is it's not. As long as you're not trying to buy and sell, Warren Buffett's comment was, there's always a fool in the market. If you don't know who the fool is, it's you. So the day trading thing is, you're trying to bet that you're smarter than the market, which usually doesn't work. What we're talking about is you're taking money and you're always putting it aside where you don't see it. And then it's building wealth long-term. That's a whole different thing. That's not a zero-sum game. Everybody who puts money into the market will probably end up with 8 or 9% returns after a 10-year horizon. And it's not who you're trying to bet against, or it's not the fool in the market thing. But anyway, enough on that topic. We should shift gears here. There were a number of posts and questions in the Facebook group. And William, I promised to come back to your follow-up sequence here. But before we do that, I want to talk about a couple of other things. And I do start to sound like